And joining us now, we are live at the Cattle Industry Convention in New Orleans. He is joining us from his office in Kansas as we take a look at the market trade action we saw on Wednesday. We are joined by our good friend Mike Zuzolo with Global Commodity Analytics. Mike, great to catch up with you, sir. We have an eventful market day to talk about here on Wednesday.
Yeah, and it's a great week to talk with you being at the New Orleans show and talking to the cattlemen while I was talking to cattlemen in Leota, Kansas, and up towards Kearney, Nebraska, and seeing a lot of feedlots. And a good week to talk about the inventory report and also the wheat and also the big Fed just coming out with the press conference just starting.
Yeah, I know the cattle inventory report. We're going to talk about that later in the show. I want to start with the Fed news, though. Quarter percent, 25 basis point rate hike as expected. That news coming out here on Wednesday. As you see that news and hear the comments from Fed Chair Jerome Powell, I know a lot of folks really paying attention to what he has to say. What are you getting from his comments here, Mike?
The biggest thing is we did a quarter point rate hike, and he didn't shock the market and make it a potentially very bearish commodity and risk off trade by doing a half point, which I think there was a small chance that he could do that because they were really being aggressive up until this month. That leads me to the second big point, and that is they went ahead and dropped the word pace and added the word extent, and that may not mean much, but what it means to us in the analytical business, Jesse, is that it's more likely that they will keep on knocking inflation down, but they won't use a sledgehammer. They're going to use probably more like a ball peen hammer, and that's very comforting to me because it helps, I think, reduce the possibility of overshooting by over tightening. Because keep in mind, they're raising rates and they're tightening their balance sheets. They're squeezing liquidity at a historical pace, quite frankly. And I'm not saying they didn't need to, but I was starting to get very nervous. They were doing it way too fast and essentially doing 3 years of rate hikes and liquidity squeezing in the mindset of 1 year. And this is, I think, their eighth rate increase in a row. It may have broken a record for more than 50 years. So those are the two biggest things. I think the big thing that Powell's press conference just started when we started going on air, and he did talk about housing weakness in his press conference. And on their press release, they also talked about the idea of maybe in the markets anyway of weakening wage growth. And I think these are the two big factors that maybe are making them scale back. So in the final analysis, as we talk, the U.S. dollar is still weaker, but it's not near its lows. Crude oil is still lower and near the low end of its range before the report came out and before his testimony or press conference, I should say, started. But that could be in part because those crude oil stocks numbers were so burdensome again today. That really led us from a dollar plus higher move to an almost $2 lower move relative very quickly. So a lot of noise in that crude oil market today.
A lot of noise in the crude oil market, and as you mentioned, the dollar weaker. And with the Fed news, your thoughts? How does that parlay into the commodities, into the grains? I know Wednesday, cord wheat wrapping up relatively mixed. A lot of pressure, a lot of spreading between old and new crop beans, which I'm sure we'll get into. But just overall, the Fed. What are your thoughts with how that plays into commodities here, Mike?
Yeah, excellent point on the spreading. A lot of people didn't notice that today. So kudos to you, especially being at a show, because we also had a lot of bear spreading in the corn where the March was down and the D's was actually up quite a bit at times. I sent two charts, one wheat and one agriculture index, and maybe that's the best place to kind of visualize where I'm at. This is a Bloomberg grain commodity index, and it's really important because those numbers there, 2, 3, 4, 5, those are cycle lows or major lows in that chart, and it's a monthly chart. And we talked about this chart before, Jesse, along with some other key charts that are really forming a tight triangle wedge compression. I did a really nice group of guys met up with in Leota, Kansas yesterday, or I should say Monday. And one of the guys came up to me afterwards. He said, I get it. I know you're talking about these triangles being so important, but why are they so important? And I said, I wish you would have asked that question during the presentation because that's a huge question to ask. And what it really is to me is kind of like a spring. If you think about a truck spring or you think about a slinky, the harder you press in on it, the more you compress it and the more energy that's going to be likely released. I see the markets the same way with these wedges, with these triangles, because you're creating an environment where you're having more constricted highs and more constricted lows. So your highs are lower, your lows are higher, and they actually naturally form a wedge. And this wedge is really coming in nicely, and it started back in 2020. So the net result of this chart, what I would suggest to you is, because of the cycle counts and this low that we put back in 2020, because of, in part, the pandemic, I would say that we have really one good shot to the upside here, as long as the Federal Reserve doesn't do anything to disturb it, because this cycle from the last low is kind of getting long in the tooth at this point, because you would typically go up 3 years and down 3 years, or up 4 years and down 4 years. So we're getting to that point where we should be getting to a top and getting ready to turn the corner. So those are the things to watch out here after this Federal Reserve report, because this cycle point, this wedge point, this Fed meeting, all coming together, in my opinion. And I think I would really like to see a second half, rest of February essentially, but essentially the second half of February really start to kick this market into a higher gear to the upside.
And to tie in with your point here, I'll flip on the video to the other chart you mentioned you sent me, and this I think goes along well with what you and I've talked about the last couple of weeks, looking for wheat to be the upside leader in these grain markets. This is a wheat chart. Walk me through this chart, how that ties into the one we just talked about, Mike.
Well, and I added exactly, and I added two things. I added the Fed policy shift, allowing inflation back in 2020, very highly correlated with the chart we just showed you, where the number 5 low came in. And then we came in with the 22 in March of 22. The Fed said, we're done with this inflation. We're sick of being beat up because of our use of the word transitory. We're going to use that sledgehammer on you. And boy, did they ever. They put the high in, and it wasn't just because the wheat demand fell out of bed for the United States. It was really about the Federal Reserve, in my opinion. So now you're going to really test my analysis. Am I right about that? The Ukraine war, has it gotten any better? No, it's actually gotten worse. So where's the Ukraine war premium? Well, it never was about the Ukraine war premium, I think, Jesse, after June. I think it was really about the Federal Reserve, and I think we're going to find that out. But this same point's coming together in no small part because the Bloomberg grain index does have wheat in it. And so it makes sense that many charts that make up that index would have a wedge or close to having a wedge in it. So I am hopeful with the oversold indicator, and some of the momentum indicators, like that bottom green line is a momentum indicator. It being at 0, it would suggest that we're ready to go higher. And what my goal ultimately is that purple line. It's that 52-week moving average all the way up at $9. I think that's where we need to be to price in that Ukraine war premium again.
Mike, as well, I would love your thoughts. I haven't looked too much at the weather forecast today, but soybeans, some of that pressure there and some of the spreading, I wonder, was there any change to a South American weather forecast that I missed, or was it maybe the case of just some profit taking to start a new month? That's a typical kind of move we could see when we begin a new calendar month.
Yeah, I think that was exactly what was going on too, in the sense that the stock market was really giving getting a lot of pressure to the downside. So I think it's new month, Federal Reserve, long liquidation in soybeans. Probably the one thing that bothers me a little bit more, though, as another major factor, is instead of the weather, it was South American related, and that was a private forecast coming out in Brazil, raising expectations back up to 154 plus million tons on soybeans. And USDA ag attaché reports have really started to be peeled off here in the last 2 weeks. And we got one from Argentina and we got one from Brazil. And Brazil's corn and beans were higher, not much higher, but higher than the official USDA number, while the Argentine corn number, it was slashed by the ag attaché. I think they went from official number 45.5 million ton corn crop down to, I think, a 36 million ton corn crop. It just got slashed. So, but back on the beans, we had some fundamental data that did not support the idea that we needed to go above 1460, 1470 in the March beans, because supplies got bigger with a couple big reports.
We're talking with Mike Zuzolo, Global Commodity Analytics, here on today's Market Talk. Mike, I want to give us plenty of time to talk livestock and the protein sector. Cattle inventory report was out Tuesday, and pretty much, I feel like numbers came in as we anticipated. We were looking for that continued contraction, shrinking of the beef cow herd, and just looking at the cattle inventory in general. Let's just start. Let's look at the numbers and walk me through some of the headline numbers that you saw, Mike.
Yeah, it's funny. This chart came out from USDA after the report, and I really appreciate these charts coming out after the grain and livestock reports to help explain where their methodology is coming from. And I really like this chart because it kicks out dairy. You know, Jesse, when I look at the major beef production states, I essentially knock out California, even though they'd be in the top five, because I think most of their numbers are dairy at this point. But this chart really shows beef cows, and it really shows the last time we made that major high, you and I've talked about it, price high was back in 2014. That's what we're all talking about in the ranch and in the feed yards and in cattle country right now. And even corn country is talking about that because we're seeing a lot of corn move out west. And that 2014 high, you would think would be getting close to being made or replicated because we're getting about 10 years out from that last high. And so that cattle cycle of 8 to 10 years in production kind of loosely matches up with price highs and lows, and they tend to work opposite one another, obviously. But this beef cow number being at where it was took us down to a level not seen since 1961. And I think what's even more important is if you look at cows and heifers that have calved at 38.3 million head, that matches the 2014 number almost perfectly. But that number back in 2014, when we made that low, was also the lowest since 1941. So the question could be asked, why did we break so hard, especially in the feeders, given these massively low numbers? And I think it really just goes right back to the slaughter and the percent of slaughter the females continue to carry, and that on feed January 1 number at 14.2 million head versus 12.7 million head back in 2014, where that green arrow is. We got a lot on feed still, and I still think it's those females kind of messing with our market and skewing it.
Well, as well, I look at how the futures traded on Wednesday, and I think we can rope a little bit of that into the conversation. Pretty much a down day across the board. Live cattle, feeder cattle, giving back some of what we priced in maybe to begin the week. So I wonder what you saw with just the reaction on the board on Wednesday, and then also tied that in with this next chart we have up on the video screen.
Yeah, really nice way to segue because I think that this also helps with the inventory report. And I think cattle producers that are watching right now, and it would be good if you were watching because this chart is really a neat chart that we're looking at right now. But I want to call your attention because of our mindset with the supply side and the price. Notice in 2010 when we made a price low in December of 2010 where that first blue bull is. Feeders did not lead the fat cattle. Both of them made a major low in December of 2010. The same thing in 2014. That October high of 2014 was made in fats and feeders in the same month of October, and the exact same thing in 2020. That May low in 2020, where that one, the next blue bull is with the green line next to it, both of them made major lows the same month. So I think we need to take away the idea that the feeders are going to bottom first. That was my first inclination in terms of futures market. Maybe the cash price of feeders will find its support first because of the tightness once we get done liquidating this herd and start to try and retain again. But I think I'm going to look at the fats and feeders almost identically because these other major highs and lows. So that's point number one. Point number two, the way we just talked about the females and the low beef cow inventory, but the high percentage of slaughter that they're still in makes me think about 2013, where we made a run and we made a high in early 2013, but we had a significant pullback. But that was actually a base to go on up and make that 2014 and kind of check that high in early 2015 type of price action. I'm not so sure that the way this cattle report came out, Jesse, that we're not kind of where we were in the beginning of 2013. And that would make sense from a 10-year cycle standpoint because this year's 2023. So that's not a hard piece of analysis yet, but it's certainly something I'm looking at now that we've seen these report numbers, and they are very, very skewed from taking a kind of a bearish feeder report versus a very, I think, historically bullish cattle report. Last thing I'll say about this is we are really losing a lot of numbers here at this point. and to be done down to 1941 levels for cows and heifers that have calved, it's really sad as a person that works with cattlemen. I really hope we rebuild this herd. And we just don't keep curbing and cutting the cattle herd, the beef cattle herd, like we did in the 20th century.
Well, to your point, I know that's a big conversation here at the Cattle Industry Convention. What's it going to take to rebuild this cattle herd? And then also, I like your thoughts. Sometimes we get caught up in the here and now, Mike. Got to sometimes look at the past to look at trends that happen to maybe let us know where we're going here now and in the future. So I think that's a very key point to keep in mind here, as you alluded to, as we look at this cattle market, Mike.
It is, and I've already seen the articles where be ready to pay more for your hamburger, be ready to pay more for your steaks. And all that does is chase the demand away when you need the demand the most to be able to rebuild your herd. And what I heard the most in cattle country this week, and I bet you're going to hear probably tomorrow once you get out of the policy meetings and talk to more ranchers, probably, is the idea fertilizer prices are killing them, interest rates are starting to kill them, and the cost to feed to gain is killing them because of this weather that we've had. And so there are many factors working against the cattlemen right now that could become worse if we don't hold these prices at elevated levels and get maybe a bit of a pullback in the feeders. And so my wish list in the next 6 months is that we do get a pullback in the cash feeder market. It gives the cattleman a chance to retain and start to rebuild his herd. And that then they can start to keep making some decent money before these retail prices get so out of whack that we really see it in the restaurants and we see it in the grocery stores. The one thing that really stands out to me is in terms of a future mindset, Jesse, and that question you asked is this report puts more pressure than ever on the hogs to find a low and not see supply backwash into the domestic market, given what this cattle report said. Because if you have relatively low pork prices and very high retail beef prices, you're going to see a lot of loss in demand, I'm afraid.
Real quick as well, hogs, another rough day in lean hogs Wednesday. I know that front month contract continues to contract the cash, little over $1 difference there now. But I wonder, was that spillover pressure from cattle or something else you're seeing in this hog market that just continues to struggle, Mike?
No, I do think that Feb April spread is really driving the traders crazy right now. We got to bring that together. The bright spot in the hogs so far, at least at midday, was the cutout was holding around 80.50. So I'm hoping as I see the afternoon close, we've made a low. That 79.50, $80 level in the cutout is the low in the market. I think it should be, but I will be watching very closely those export sales again. I hope we have a really good week for both the beef and the pork. And I'll throw one other thing out with the hogs too, Jesse, since you asked. The dollar currency market's going to become more and more important when it comes to getting those exports out. If we would see the dollar rally sharply, then we'll probably bring imports in and really cut back on our exports. And that could really mess around with the pricing structure for cattle and hogs in the first half of the year, especially.
Mike, we covered a ton of information as always here on the show today. Final thoughts, anything else you want to reiterate to listeners, viewers here on the show today?
Only thing I'd say is I think I got a lot of really good feedback after the presentation I gave in Leota and after I talked to my client in Kearney. I really want to stress maybe picking up a trial at globalcomresearch.com because I'm going to start putting these up as webinars and maybe pay-per-view webinars in some cases. But think about subscribing if not wanting to be a cash or brokerage client, because I think I can bring a lot to the analytical table to help you think and go through some of the stuff and maybe blank out some of the noise in this market.
And you can find, again, the details at globalcomresearch.com. That is com with two M's, globalcomresearch.com. Mike Zuzolo, Global Commodity Analytics. Always a pleasure, sir. Thanks for joining us. We'll talk to you again next week.
Thanks, Jesse. Have a great time at the show.
Thank you very much. That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great day.